Sgbx was a company beating the Dow, S&P, and the Nasdaq for over 9 months, but in a matter of 2 months, their valuation has gotten cut in half. And with these earnings not being what many people expected, it begs the question whether or not this company is still a buy even though it is trading just over $1 a share. So in this video, I'm going to talk about what happened in their earnings and share what I'm doing with this company, whether I'm buying, selling, or holding. But I don't want to waste your time, so let's go ahead and dive right in. For those of you that haven't heard of this company, Sgbx is a modular construction company that is focused on creating residential apartments, medical facilities, and a variety of other structures through their prefabricated modules. I personally have owned shares of this company for 2 years now and have experienced all the wild things that happened in that time. In January of 2021, the stock touched $8 a share, and even though there were some short spikes here and there, the share price has fallen all the way back down under $2. Of course, hindsight is 2020, and I probably should have sold in January of last year, but it is what it is, and I want to focus on where the company is right now. So let's talk about what the numbers are for the company and where I see them going. For Q3, they reported $4 million in revenue, which is a decline of 53% from the third quarter last year. Now, let me be the first to say that this was awful. Not only was this lower quarter over quarter, but this was a significant reduction year over year. Now, they did say that it was primarily driven by the decline in the medical segment, and this makes sense given the fact that COVID is not really mentioned much at all, but it doesn't deny the fact that a 50% reduction in revenues is not good. With that said, let's break down their revenues because I think this will be important when we look at the company moving forward. Their revenue is split up into 2 segments, construction and medical. First, let's cover the bad news, which was their medical segment. Year over year, their revenues declined over $6 million from $8 million last year to only $1.4 million this year. Now, the problem is that we aren't seeing anything else really come from their point of care testing except for the new project with Teamsters 848. Paul Gavin, the CEO, says that their medical facility capabilities provide mobile labs offices, clinic sites, among other medical facilities that can disrupt the on-site medical construction industry. And this could be true, but we have to see actual results. And until I see this, I have to take what he says with a grain of salt. Now, they should be sharing more info in the coming weeks and months about their medical waste solutions partnership with Sanitec. This has been separated into 2 phases. First is carrying out the strategy of setting up processing plants in Oklahoma. The second phase is going to focus on the cruise line industry. So hopefully we will get some updates soon about how these solutions will produce the high profitability that they are talking about. But I don't want to get my hopes up for this. However, with all that said, there was actually something with their revenues that I was even more frustrated about, and that was the cost of revenues for the medical business. While revenues were only $1.4 million, their cost of revenue was $1.6 million. The problem is that this segment was supposed to drive their construction business. But when we are seeing gross losses in this segment, the question now becomes, where is the capital going to come from in order to execute on more deals? Now, personally, I think their pipeline is big enough and they need to start executing. So this isn't a major factor right now. But until we see a solution that helps the company make money so they can deploy it elsewhere, I'm hesitant to really believe in this segment. Okay, now onto the construction revenue. This was probably the best part of their entire earnings report, and I don't want this to be missed. Last year, their construction revenue was only $612,000, but this year, that number increased to almost $2.7 million. This is a substantial increase, and this is what I've been wanting to see from this company. When we look at cost of revenue, it was relatively similar as they only lost a couple $1,000s. So even though surface level this appears to be horrific numbers, it's important to understand where these revenues are coming from. In the past, they relied heavily on their medical segment when COVID-19 was on the global news. However, now they have finally started to shift to their main part of their business, which is on the construction side. So all these losses came from medical, and I think next year the company won't need to worry because the comps are going to be much easier. And one major thing that I talked about last year is that I didn't care too much about these first few quarters of 2022 because their main business segment, which is their construction services, wouldn't really start ramping up until the very end of 2022, but more so in 2023. And what these numbers are telling me is that they are really starting to focus and prepare for their major contracts that they have coming up. So yes, I'm not happy with the massive loss in revenues, but at the same time, I have to remember that their major execution won't really start until next year. So they really just need to get through these next few quarters without burning a lot of cash. Also, if we compare the revenues from 2 years ago to now, they have grown over 7x. And how many companies do you know can still do that? Looking at the balance sheet, the company only has $2.1 million in cash, which is lower than last year, but they also have $2 million in an escrow bond and another $1.7 million in accounts receivable. In terms of debt, the main ones that I want to cover are the $2.5 million short-term payable note and $750,000 in long-term payable notes. But overall, the asset to liability ratio isn't that bad. SG Blocks has total assets at about $29 million, and they have total liabilities of $10.7 million. But a number that I think has to be heard is that the stockholder equity is at $18.2 million. And what is the company valued at? Over $15 million. So in other words, the market believes that the company is going to lose more money and valuation is going to shrink over time. Plus, management believes that there is not an urgent need to access the capital markets. But what truly determines the value of a company? Is it revenues? Is it net income? Is it the amount of cash on the balance sheet? Is it gross margins? I really don't think it is any of those metrics. If we look at McDonald's, for example, they are valued at $200 billion. But when we look at the revenues over the past year, they had about $23.5 billion. But here's something that the former CFO said about the company. We are not technically in the food business. We are in the real estate business. The only reason we sell 15-cent hamburgers is because they are the greatest producer of revenue, from which our tenants can pay us our rent. I absolutely love this because when we look at the bigger picture, a company's real estate plays a huge role when it comes to if a stock is undervalued or not. Now, of course, you still need to include things like revenue growth and net income, but I firmly believe that real estate is not talked about enough within the stock market. So when we look at their appraisals, here's what we got. The manufacturing facility in St. Mary's has an as-is market value of approximately $2.4 million. Their Norman Berry property has an as-is market value of $5.5 million. With their McLean site, they have two different parts. First is their apartment site appraised for $3.7 million, and their industrial business park appraised for $16.2 million. Lastly, their St. Mary's big multifamily project has an as-is market value of $3.4 million. And with all of their properties and lots, they have a total appraised value of $56.4 million. And they only purchased these assets for $8 million. Once again, with a market cap around $15 million, this appears that the company is undervalued. But with all that said, we can't simply use appraised value as the way to find a company's valuation. We also need to include how much the company has in debts as well. It's like if I owned a home and let's say that the home was $300,000, but I have a $250,000 loan. I can't say that my net worth is $300,000 because I still have $250,000 in debt. And so we need to apply the same basic principles here. Now that doesn't mean that the company isn't undervalued, but we can't just use property values to assess the company's market cap alone. Just looking at their projects that they are working on, these are the as-is values right now before construction. And this is important because the appraisals after completion are massive. So I encourage you, if you haven't done so already, look closely at these appraisals and see where they are right now and the potential that SG Blocks has with each project. The last thing that I would like to say about these appraisals is keep in mind that they have partnerships, so even though these projects are valued at where they are split amongst their partners. Regardless, the kind of properties that they are working with, as well as the kind of revenue that they could generate from either selling or renting, is massive. And that is why I love the fact that SG Blocks is open with each property when it comes to their exit strategy. The thing about SG Blocks that I have to mention is we need to understand the business of construction and real estate. Unlike other sectors, SG Blocks needs to spend more in upfront costs and wait longer for their returns. And this is more important when we start talking about the larger residential projects. When someone is building from scratch, they will not only need the resources, but also the funds to build. And they won't start making money until those projects have been completed and are starting to sell. So keep that in mind when you're observing the balance sheet, because it may look like the company doesn't have cash, but they have some in escrow, and some of the loans that they receive are helping them get the product done so that they can be making money from those contracts later. And this is why I've said a few times when I talk about this stock, if you don't believe in the team's execution, then this company is not for you. When I evaluate this company, even though there have been some hiccups, the amount of manufacturing space and deals that they have been able to receive despite these hurdles is proving to me that they are well positioned to execute. Now, with all that said, the company estimates that their manufacturing pipeline is at $800 million. This doesn't mean that they will get the entire pipeline, but there's definitely potential for them to generate significant revenue over the next 5 years. Now, here's something that I need to specify. These projects will not generate solid margins until much later. What they have been doing is using their margins from their medical vertical and take that money to invest in their construction business. But once we begin to see revenues come in from their major projects, their margins will begin to show. So they are expecting gross profits to be at $120 million, assuming they complete the entire pipeline. However, I said before, they need to execute on these contracts because anyone can say what the numbers will be, but until they get the job done, these numbers won't count for much. Now, what I'm really excited about when it comes to SG Blocks is the kind of revenue that they will be able to generate. Because they are in the real estate development space, they will get revenue from their sale leaseback for their factories, developer fees, refinancing, asset sales, and operating income from these projects. As someone who is a real estate investor, the different income streams gives SG Blocks not only diversification for safety reasons, but it also gives them the opportunity to pivot in case market conditions change. So there could be times where the company has several different projects and each one of them could have a totally different exit strategy after completion. And this leads to the piece of news that was announced during the conference call. It was reported that the development team saw a path to bring Lago Vista site development work in-house rather than selling off the property to a third party. Now, I'm really hoping that they will bring more clarity to this because this affects multiple aspects of their business. First is their share buyback. On September 7th, SG Blocks announced that they have increased their share buyback program to up to 1 million shares. This was huge news and something that I believe many investors were really excited for. I mean, any company who does share buybacks proves that they believe in the company long term and that they will have enough cash to do this. But we are going to need to see how they can get the cash to repurchase these shares. The second aspect is how is this going to affect the status of their other deals? With the company planning on expanding production massively in 2023, how are they going to be able to execute on all of their contracts? On August 22nd, they closed on their 22-acre St. Mary's factory project, which will help them build a massive 1,286-acre waterfront community. Now, please note that this project will take some time, so don't expect this to be completed in the next couple of years. They will be breaking ground on this factory project in Q2 of 2023, and so they need to make sure that they have the facilities and manufacturing capabilities to execute on their contracts. And speaking of contracts, on November 7th, SG Echo announces an expected $11.5 million expansion with its largest client. They previously announced in April a purchase order for more than 100 units, which would generate $6 million in revenue. And now with their fourth order, they are currently at approximately $11.5 million for this contract. But they are anticipating to have more orders from this client in 2023 as well. Now, one thing that I've said numerous times that I think is a caution flag everyone needs to consider with this company is that they have a lot of different verticals, and this could be cause for concern. When companies, especially smaller ones, begin to diversify a little too much, some of their projects can begin to lag. With SG Blocks, what I don't want to see is that they put more effort into a different segment from their real estate business, and those projects begin to slow down. I don't think it is a reason to sell because as of now, they are demonstrating progress in the real estate segment, but it is still something to consider and keep an eye on in my opinion. So what exactly am I doing with SG Blocks? I'm holding. I don't want this one to be a major position, as I already have companies that are executing and are either just around the corner of being profitable or are already profitable. I've had this position built out, and I still like the valuation for several other companies that I haven't fully built out yet, like Shopify and Palantir. I think until we really start to see how well they execute on those verticals, there is still a decent amount of risk involved. But the fact that the company is buying back shares, they are versatile when it comes to their exit strategies, and they continue to grow their manufacturing space, I think this company has put themselves in a position to grow for the next 3 to 5 years. Hope you all enjoyed this video, and I'll see you in the next one.